Welcome to The Explainer. Today, we're literally cracking the case on what a company is truly worth. We're going to move right past those surface-level accounting numbers you see flashing in the headlines and dig into the actual mechanics of valuation. Because, as it turns out, the true value of an asset isn't just what someone else is willing to pay for it on any given day. It's totally grounded in the actual cash it generates.
So let me ask you this. Why is it that reported net income, that shiny bottom line number we're all sort of trained to look at, is so often a complete illusion? Think about it. You'll see a company report absolutely record earnings, yet somehow they're constantly strapped for cash. Well, that's because accounting measures of earnings can be incredibly misleading. Operating, capital, and financial expenses get misclassified all the time, basically acting as a smokescreen that hides the real cash-generating power of a business. To find the truth, we've got to strip away that accounting fiction.
Okay, let's dive into our valuation funnel. We'll be hitting 5 steps today. 1. Going beyond the earnings illusion. 2. Adjusting the operating base. 3. Navigating the tax reality. 4. Calculating reinvestment needs. And finally, 5. Finding the free cash flow.
Starting off with Section 1, Beyond the Earnings Illusion. Let's clearly define our ultimate goal for this investigation. We need to calculate what's called free cash flow to the firm, or FCFF. This is the true, unadulterated cash left over for all investors after taxes are paid and all necessary reinvestment needs have been met, but, and this is key, before any debt payments are made. It's an unlevered cash flow. We focus intensely on this because it tells us the absolute cash-generating capacity of the business itself, completely separate from how it happens to finance its operations.
Moving right along to Section 2, Adjusting the Operating Base. To actually get to that pure cash flow, we first have to fix our starting point. We can't just take operating earnings, or EBIT, straight off the income statement without asking some really tough questions first. The biggest hurdle we face right out of the gate? Accounting misclassifications. You see, accountants have very strict rules, and those rules often force companies to classify capital expenses, which are investments meant to generate future growth, as regular, day-to-day operating expenses. The most glaring example of this is research and development. When a company spends on R&D, it's obviously investing for the long haul, right? Yet accounting rules say it must be expensed immediately. That unfairly shrinks the reported operating income.
So here's how we fix it and essentially rewrite the rules. We take that reported operating income and we add back the current year's R&D expense, treating it like the capital expenditure it really is. Then we subtract the amortization of the research asset, which basically treats past R&D like an asset that naturally loses value over time. And boom, that leaves us with our adjusted operating earnings, a much truer base of how the business is actually performing today.
Let's see how this plays out in the real world with a giant like Boeing. Because they invest so heavily in developing new aircraft, their stated operating income is significantly dragged down by those R&D expenses. If we don't manually adjust for this, we're going to severely understate Boeing's profitability and totally misunderstand how much they're actually reinvesting into their future. Properly capitalizing R&D doesn't magically change the final cash flow in our pocket, but it absolutely transforms our understanding of the firm's true margins and reinvestment rates.
On to Section 3, Navigating the Tax Reality.
Now that we've fixed our starting earnings, we can't ignore the government's cut. We have to tackle taxes, which honestly can be one of the trickiest parts of this entire funnel. The absolutely crucial point here is understanding the difference between effective tax rates and marginal tax rates. When you look at a financial statement, you're usually seeing the effective tax rate. That number reflects past deferrals, clever tax planning, and sometimes just temporary tax credits. But the marginal tax rate, that is the statutory rate the company pays on the very next dollar it earns.
While you might use a company's lower effective tax rate for your initial short-term forecasts, you absolutely must eventually converge on the marginal rate for your long-term terminal value forecasting. Why? Well, because temporary tax deferrals and credits rarely last forever. If you assume a company will permanently pay, say, a 15% effective rate when their actual marginal rate is 35%, you're going to vastly overstate their future expected cash flows and totally overvalue the company.
But wait, there is a fascinating exception here. What about startups or struggling companies that are currently bleeding money? Surprisingly, for firms carrying forward massive net operating losses, their effective tax rate literally drops to 0%. Zero. They can use these accumulated past losses to shield future income, meaning they temporarily won't pay a single dime in taxes until those losses are completely exhausted.
So you've got to track these losses meticulously to accurately forecast when that tax bill will eventually come due.
Section 4. Calculating reinvestment needs.
All right, we've handled taxes. Now, calculating what the company must spend just to keep the lights on and keep growing, that's where we calculate reinvestment. And it's not just a single simple line item on a spreadsheet. Reinvestment is actually made up of several moving parts. First, you take capital expenditures. And remember, we're now including things like R&D in there. Then, you subtract depreciation, because that's a non-cash accounting expense that actually acts as a cash inflow. Next, we must add acquisitions, because buying a whole company is really just an external capital expenditure. Finally, we add any changes in non-cash working capital, like when a company has to tie up its cash by stocking up on inventory.
These components can be incredibly volatile. Think about the stark contrast between companies. You've got massive consumer giants like Coca-Cola and Nestle reinvesting positively to grow. But then consider a historical case like Sony. At one point, they actually had more depreciation than capital expenditures, a decrease in working capital, and paid off debt. So their net reinvestment rate was actually negative.
And let me tell you, a negative reinvestment rate is a massive warning sign. If a firm continually has negative net reinvestment, it's essentially living off its past investments. It's like wearing down your existing machinery without ever replacing it. While this might artificially boost free cash flow in the really short term, it means the expected growth rate in future earnings are inevitably going to decline. Bottom line, you cannot grow long-term without reinvesting.
And finally, Section 5, finding free cash flow. All right, we have all our pieces. Let's put this together on the assembly line. Step 1, start with your adjusted EBIT. Step 2, apply your tax rate to get that after-tax operating income. Step 3, add back that non-cash depreciation. Step 4, subtract your real capital expenditures and acquisitions. And Step 5, subtract changes in working capital. Do all of this, and you have successfully stripped away the accounting noise to find the real, actual cash.
When you apply this rigorous funnel to a young, rapidly growing firm, the underlying story becomes incredibly clear. Take historical projections for a company like Tesla Motors, for instance. Because they had massive early reinvestment needs, building new gigafactories, heavy R&D, their free cash flow to the firm was highly negative for years, even as their operating margins were improving. It's a perfect example of how high growth requires high reinvestment, creating a huge cash drain before the company eventually turns the corner into positive cash flow generation.
Just to be perfectly precise here, keep in mind that the free cash flow to the firm we just calculated completely ignores debt payments. It's the cash available to everyone. If you want to know what's left exclusively for the shareholders, you need to calculate free cash flow to equity, or FCFE. That metric takes our firm cash flow, subtracts interest and principal debt payments, and then adds in any new debt issued.
This final equation is exactly why tracking all this reinvestment matters so much. It's not just some dry accounting exercise, it is literally the mathematical engine of future growth. Your calculated reinvestment rate, multiplied by the company's return on invested capital, precisely dictates the firm's expected growth rate in operating income. If you don't know the true reinvestment, you cannot possibly predict their future growth. It's the whole shebang. So I want to leave you with a bit of a challenge. Grab the financial statements of your absolute favorite company. Look right past the illusion of that reported net income headline. Make the adjustments for R&D, find their marginal tax rate, and rigorously calculate their reinvestment needs. Ask yourself, what is its true after-tax free cash flow? You might just find that the company is worth something entirely different than what the market currently thinks. Thanks for joining me on this explainer, and keep digging for the truth.